Welcome everyone. Gib McEachran, John Hardy. It's a kind of a special edition of Money Matters, and if you received an email from us last week and you read it, hopefully, you will have seen that there are some upcoming changes that we will be making in portfolios in the upcoming days, maybe in the next week, 10 days. We're concerned, as you could probably tell from our email, from everything from the election that's coming up, the fiscal cliff, what's going on in the Middle East, slowing corporate earnings, and China also is slowing down. And oh yeah, Europe. We can't forget Europe. That's still out there, and really with no reconciliation there, just a lot of talk. And with all of that that's mounting out there, and considering that your portfolios have performed well over the last year, we are looking to make some moves, and we wanted to talk to you about those moves and why we are where we are today.
We don't take this lightly. We spend a lot of time within the office. Mondays is the time the whole office gets together, and then after that, Gib and I usually meet with Jeff Herzik, who in our office is talking to a lot of the analysts that we talk to. And we're now coming up on the second or third week of what has been a continuation of talking to some very high-level individuals. When I say high-level individuals, I just don't mean individuals here on a local basis. You and I have taken the time and the effort to go to folks who are on a world scene, who are on a world node, within the management team that we work within DWS, Federated, Lord Abbett, PIMCO, even our own LPL. And we have posed the questions before them of how really are our portfolios going to react if we see some of these things that we're seeing right now occur. And with that information, with that knowledge, then you and I, with Jeff and our other staff, have sat down and said, okay, what is our obligation? What's our due diligence for our clients that we should be doing? And thus it brings us to this point in time right now.
It does, and we take the management of your money very seriously. And the consensus that we received from the folks that you mentioned, whether it's DWS, PIMCO, Federated, Columbia, Lord Abbett, and whomever else we've spoken with, the consensus is there's going to be a pullback in the market. And that pullback is a range from 7 to 20% based on how the election goes, based on what happens in the lame duck sessions of Congress, what happens in the Middle East, what happens in Europe. And that's a wide range, obviously 7 to 20%. But it's a range that we feel that we can manage somewhat and begin to make some changes to, again, help protect those gains that we've had in your portfolio, and more importantly, to protect you on the downside should we see further erosion begin. And we just think that there's some prudent moves that are coming up. So, John, why don't you talk a little bit about some of the moves we're talking about?
What we're going to begin to do is work from the outside in. And what I mean by that is that we're looking at portfolios, and we'll talk a moment from the stock side of things, the equity side, the mutual fund equity side of the equation. We're looking at those funds that are growth oriented, those funds that we recognize that do not pay dividends but are oriented to provide growth to your portfolio. They are the very ones that this year has provided good performance within the portfolios. However, let me stress again, they do not pay dividends. They are in the categories of large company stocks, mid-company stocks, and small company stocks. We virtually do not carry any emerging market or international. We moved away from that some time ago. So we're going to start on the outside, and we're going to begin to either change those over to if they have a brother or sister in a very short-term, say, bond position, we're going to make some transfers. If not, we're going to raise cash with those and put your portfolio with carrying more cash than before. What we are going to maintain at this first stage are large company stock mutual funds that pay dividends. If what we're seeing doesn't transpire as quick as we see, and we still have a fourth quarter run up, we want to be part of something with that, but we want some dividend yield with that. So the equity side of things, we're going to work outside, get rid of growth, and the next potential step, if we need to, would then be to address those large company stocks or large company stock funds that pay dividends.
However, we will be reducing some of the exposure in the large cap value sector,
right? Because
again, we've had a lot of run up in that area, and we want to protect some of that run up. So and we will reduce some of our exposure there, but keep our large cap value area as a viable player should the markets rally due to the election or due to some things being resolved as far as.
I think it would be fair to say, so folks could have a sense, it would be fair to let them understand at this first move, we would be moving somewhere between 10 and 20% inside that equity piece over to the cash or bond side.
That's correct. And within the bond side, we also will be moving from some areas that have correlation with the stock market. Bonds typically correlate little to moderate to greatly with the stock market, meaning they move in conjunction with. And in some areas, like high yield, and sometimes in strategic income type of areas, we see a lot more correlation than we like. And we'll be removing some of that correlation by moving within our bond family of funds also. So you'll see some change, obviously on the equity side, as you've gone through, and on our bond side, on our bond mutual fund side also, by moving within those families of funds to reduce correlation within the markets.
You'll also see us raise more cash. You'll have more cash in your portfolio than we normally carry. That's going to be a temporary position. How temporary? Well, we aren't going to let it go a long time because we know it's not productive. But also think in terms of this. If this scenario plays out, there might very well be a buying opportunity on the back end of this, and cash would be the great thing.
Absolutely. And even in 2008, we go back to those horrid days, even the bond market there was unrest in the bond market, and we saw those areas also get shaken, at least for a temporary period of time, and the cash then just has that stability factor that keeps the portfolio from having any wake at all in it during that period of time. So that's phase one, and phase two would be a little bit more dramatic pullback, especially on the equity side in the large cap value areas, and perhaps even more so on the bond side. But it would definitely be on the equity side as we would get more defensive, especially from the large cap value dividend mutual fund area of your portfolio. So that would be phase two. We hope not to be doing that, but the timing on phase two would be leading up to the election, maybe right after the election, and as the lame duck session of Congress begins. If you remember the TARP proceedings going back to 2008, 2009, and how rancorous that was, we want to avoid that too. So maybe that phase two would go on during that period of time. Still a lot of time before that were to occur. We just think it's prudent to begin to think about making these moves to, as we said just a little while ago, protect some of the gains that we've had in your portfolio, and to try to stabilize what we think is out there into the near future, and then look ahead for opportunities as they present themselves, perhaps in the first quarter or second quarter of next year.
Anytime you sit down, and we sit down, we take it very seriously, and you hear the information that we hear, and you see the three potentials out there. The potential of what could come out of the election and how the economy and how the market would address to it. The Middle East potential that we have right now. And then Congress and its inability or ability to try to come together to solve some problems in a very short period of time. If any one or two of those scenarios went the wrong way, then we're going to have a dramatic change in the marketplace, and it's going to affect your portfolio. You hire us not only to make you money, which we feel good about where we are thus far, but you also hire us to make tough decisions to protect it, and that's where we are at this point in time. We won't sit on it. We'll take data on a current basis and make changes as we see fit to put your interests first.
We think they're prudent moves, and we'll begin those moves probably in the next week to 10 days. You'll start to see some of those moves. We invite you to give us a phone call, 336-544-6800, or email us. You have our email addresses. Feel free to ask whatever questions you have, but as always, it's your money.
And your money matters.
We'll talk to you soon.
It's your money and your money matters. For the best advice to help you succeed, turn to Gibb and John. They know what you need to make the right financial decisions. Turn your radio on and listen. your money.